Hi, I'm David Witter, founder and CEO of Financial Office Wealth Advisors. Great to be with you today. Common question I've been getting here in the last few weeks is, David, is the market overvalued? And I subtitled this Investing Principles in Today's Pandemic World. And I think to answer the question, is the market overvalued, we really need to break that into three questions. First of all is, what is the market? Number two is, how can we make an assessment of whether it's overvalued or not? And number three is, what do we need to be doing now to be successful here during the pandemic? Let's jump in. First thing I did was I took the S&P 500 and then looked at only the top 5 biggest companies. These are companies you all know. Amazon, Apple, Microsoft, Facebook, and Google. They represent 25% of the market capitalization of the S&P 500. You can see here on the returns that those 5 big companies have really had handsome returns year to date, much greater than the S&P 500, which is in purple as a whole. When you look at it closer, those 5 companies, on average, their year-to-date return is somewhere around 46%. Look at those big numbers. The next thing I did was I took the 46% from the big 5. I scaled it because it's 25% of the S&P, which means that the S&P, the returns, total returns, 11.5% of the positive returns are coming from those big 5. What does that mean that the other 495 are doing? They're actually down year to date 6.4%. That is a big differential. It means that those 5 companies, if you subtract out their performance, the 495 U.S. largest companies are actually negative year to date. They're still underwater. So when we say the market, be careful what you mean by the market. Do you mean those big 5? Do you mean the other 495? Do you mean small companies? Do you mean value companies? Do you mean international? Do you mean emerging markets? They're all different conversations and different assessments to make. The next question, remember, number 2 on our list, is how do we make an assessment of is it overvalued or not? Well, one way to look at that is something called a price-earnings ratio. Price-earnings ratio means, it's a good way of saying, how expensive is it to buy $1 of future profits? So you can see here the price-earnings ratio of those top 5 companies is around $54. You got to pay $54 at today's prices to get $1 of earnings. Conversely, the price-earnings ratio of the other 495 companies in the S&P, the price-earnings ratio is around 15. It means you have to pay $15 for $1 of earnings. So you can see it's much more expensive to buy profits on those 5 big companies versus the other 495 companies. Now, that's no guarantee that the other 495 are going to outperform into the future. But if you think about it, if it's less expensive to buy profits or earnings, that could be an argument for higher expected returns for those other 495 to catch up. The other thing I want to consider is if you are a big company, does that mean that you have higher expected returns? History says not so much. So what we did was we went back to 1927, and we always tracked the performance of the top largest 10 stocks in the U.S. You can see that 3 years after it became a top 10 company, there was an excess return of the overall market. But notice by year number 5, it was actually underperforming the market. And 10 years after it became a top 10 company, it was down annualized negative 1.5%. So you were penalized. You underperformed the overall market by owning the biggest companies. So keep that in mind as you're building your portfolio. So what do we need to be doing now? So I call this investing principles for now. Number 1 is know your purposes. Remember, your investment strategy for your long-term capital is to be able to support your lifestyle both now and into the future to take care of your family and the things that matter to you. Stay tethered to your purposes and then figure out an investment plan that will serve you over the coming decades. Number 2, guard your narrative. There's a lot of hype right now, and pay attention to what you're listening to in terms of the market, which is number 3. Be careful when you hear the market and performance, because you may own 10, 12, 14,000 stocks in your portfolio. And we just saw an example where only 5 of those 14,000 stocks is really skewing the market or the returns. Number four, long term, it's earnings that drive equity prices. So expectations of future cash flows is what will drive the stock market price of a particular stock. So think about how expensive it is to buy those profits, and those future earnings are going to drive those long-term prices. Today's big tech and big five probably won't stay there. That's what history tells us. Number six, diversify to include long-term premiums. A premium is a higher expected return based on how you allocate your portfolio. And we have to take into consideration things like book to price ratio, price earning ratio, market capitalization. So diversify to include those. And last but not least, the recovery is still going on. Sometimes when you see the S&P positive year to date, you might think, oh, things are fully back. Not for the other 495 stocks. And then you might say, well, what will trigger maybe some of those to catch up? Maybe a vaccine coming out into mass production is the triggering fact that has, oh, I'm going to go buy those cheaper stocks to get those earnings that I'm looking for. If you'd like a second opinion of your portfolio, if you're not a client of ours, or if you're a client and you have any questions on these 7 principles, that's what we're here for. I'm David Witter, founder and CEO of Financial Office Wealth Advisors.